Welcome back to Money Mastery Now, the channel that helps you take control of your money, one smart habit at a time. If you want to master your budget, crush debt, and build lasting wealth, you're in the right place. Let's dive in. Have you ever applied for something, a credit card, a car loan, even an apartment, and been told, sorry, your credit isn't good enough? It stings, doesn't it? And what makes it worse is that you didn't even know what your credit score was, or how it got so low. You thought you were doing okay, paying your bills, trying to stay afloat. But somewhere in the background, a quiet number was being calculated, judged, and used without your input to decide if you deserved a home, a loan, or even just a chance. That number, your credit score. And whether you realize it or not, it has a huge impact on your financial life. It can determine whether you're approved for a loan or denied, whether you get a 5% interest rate or a 25% one, whether your insurance premiums are affordable or painfully high. It can even influence whether a landlord or employer says yes or no. It's just a number. But it can change everything. So in today's video, we're going to change the way you see that number. We'll break down everything you need to know about credit scores, what they are, how they're calculated, what counts as a good score, what can damage it, and most importantly, how to improve it. This won't be a dry lecture filled with jargon. It's a real conversation, straightforward and practical, because here's the truth. Your credit score doesn't define your worth, but once you understand how it works, you can use it to your advantage. Maybe your score is already decent, but you're not sure how to improve it. Maybe you've made mistakes and feel like you're stuck in a financial rut. Or maybe you've avoided credit altogether and now realize you need to build it from scratch. Wherever you are on your financial journey, this video is for you. We're going to take the mystery out of credit scores, step by step. And by the end, you'll have more clarity, more confidence, and more control over your financial life. So take a deep breath, settle in, and let's do this together. Your credit score doesn't have to be scary. It can be the tool that helps you build the life you want. Let's get started. Let's start with the basics. What exactly is a credit score? In the simplest terms, your credit score is a number that represents how trustworthy you are with borrowed money. It's a rating of how likely you are to pay back what you owe. It's not based on your income. It's not based on your job title or how smart you are. It's based purely on your credit history, how you've borrowed and repaid money in the past. Think of it like a report card for your financial behavior. Only instead of getting an A or a B, you get a number. That number tells lenders, banks, landlords, and even insurance companies how risky it is to do business with you. Now you might be wondering, who creates this score? In the United States, there are 3 major credit bureaus that collect and report credit information. They're called Equifax, Experian, and TransUnion. These agencies track your credit activity and build a report about how you handle money. Then, there are companies that take this data and calculate your score. The 2 most common scoring models are FICO and VantageScore. FICO is the one you've probably heard the most about. It's used in over 90% of lending decisions. When someone says credit score, they usually mean your FICO score. So why does this score matter? Because when you apply for anything that involves money like a loan, a mortgage, a credit card, or even renting an apartment, someone is looking at that number. It tells them if you're reliable, if you've made payments on time, if you carry a lot of debt, if you have experience managing credit, and that number can affect everything. Let's look at a few real-world examples. Imagine 2 people applying for the same car loan. One has a credit score of 750. The other has a score of 600. The first person might get approved instantly with a low interest rate. The second person might get rejected or approved with a much higher rate, meaning they'll pay thousands more over the life of the loan. Now think about renting an apartment. Landlords often check credit scores. If your score is too low, they might ask for a bigger deposit. Or worse, They might choose someone else entirely, and it doesn't stop there. In many states, your credit score can affect your car insurance premium. And some employers, especially those in finance or government, may check your credit before offering you a job. It's more than just borrowing money. It's about trust, responsibility, stability. In short, your credit score is like a first impression in the financial world. It opens doors, or it closes them. But here's the good news. Your credit score is not permanent. It's not fixed. It's not something you're born with or stuck with forever. It changes based on your behavior, which means you can improve it. You're not just at the mercy of a number. You can take action to shape it. And that's what we'll explore in the next part of this video. We'll look at how that number is actually calculated, the 5 key factors that make up your score, and why understanding those factors gives you the power to take control. Because when you know what goes into your credit score, you can start making decisions that raise it over time. So stick around. It's about to get really practical. And remember, your credit score isn't your identity. It's just a tool. And starting today, you'll learn to use it better than ever before. Now that you understand what a credit score is and why it matters, let's take a deeper look at how it's actually calculated. Most people know they have a credit score, but very few people know what truly affects it. And when you don't know how it works, it can feel random, confusing, unfair. But it's not. Your credit score is built from 5 key factors. These are like ingredients in a recipe. Each one contributes a different weight to your final score. And once you understand each part, you'll know exactly where to focus your attention. Let's start with the biggest piece of the puzzle. First is your payment history. This makes up about 35% of your credit score. It's the most important factor, and it's also the simplest to understand. Do you pay your bills on time? Every time you make an on-time payment on a credit card, a loan, a mortgage, or any account that reports to credit agencies, it adds a point in your favor. But if you miss payments, even just one, it can seriously damage your score, especially if it's late by 30 days or more. So if you want to protect your credit, start by always paying at least the minimum due, even if you're short on cash, even if things are tight. Never let an account go past due. That habit alone can make or break your score. Next is your credit utilization. This accounts for about 30% of your score. This one is a bit more nuanced. Credit utilization means how much of your available credit you're actually using. Let's say you have a credit card with a $1,000 limit. If you carry a balance of $900, your utilization is 90%. That's considered very high, and it signals to lenders that you might be overextended. Ideally, you want to keep your usage below 30%. That means if your card has a limit of $1,000, try to keep the balance under $300. And here's a tip. Even if you pay your card in full every month, the balance that shows up on your credit report might still be high depending on when your lender reports to the credit bureaus. So if you're planning a big purchase or applying for credit soon, consider paying early to reduce the balance that gets reported. The third factor is the length of your credit history. This makes up about 15% of your score. It's all about how long you've had credit accounts open. Lenders like to see experience. A long history of responsible credit use is a good sign. If you're new to credit, don't worry. Everyone starts somewhere. But that's why it's often a good idea to keep old credit cards open. Even if you don't use them much, they add age to your report, and age builds trust. Just be sure the card has no annual fee. Otherwise, keeping it open might cost you more than it helps. The fourth factor is your credit mix. This makes up about 10% of your score. This simply means the variety of credit types you have. Credit cards, car loans, student loans, mortgages, personal loans. Having more than one type of credit shows that you can manage different kinds of responsibilities. But here's the key. You don't need to go out and get more credit just to improve your mix. That's not the goal. This factor matters, but it's not worth taking on new debt just for a few extra points. And finally, The last 10% of your score comes from new credit. This includes how often you apply for new credit accounts. Every time you apply for a loan or credit card, it creates a hard inquiry on your report. One or two is fine, but too many inquiries in a short time can make you look risky. That's why it's a good idea to space out your applications. Don't open 3 new cards in 1 month. And don't apply for credit unless you actually need it. So, let's quickly recap. Payment history is the biggest piece. Make your payments on time always. Credit utilization comes next. Keep your balances low, ideally under 30% of your limit. Then comes the length of your credit history. Keep your old accounts open, if possible. Next is credit mix. A healthy combination of account types is good, but not essential. And finally, new credit. Apply for new accounts only when necessary, and don't do it too often. When you understand these 5 factors, you stop feeling like your credit score is out of your control. You realize that every decision you make, every bill you pay, every card you open, every balance you carry either helps or hurts your score. And that gives you power. Because even if your score isn't where you want it to be today, you can start changing that one smart move at a time. In the next part of this video, we'll break down what those scores actually mean, what's considered poor, fair, good, very good, or excellent. And what does that mean for your everyday life? Stick with me. You're getting closer to financial clarity, and your credit score is just the beginning. So now that you understand what makes up your credit score, let's talk about what those numbers actually mean. Because the number itself doesn't say much unless you know how to interpret it. Is 600 good? Is 700 enough? Is 800 rare? Let's break it down. Most credit scores range from 300 to 850. The higher the number, the lower the risk you appear to lenders. In other words, the higher your score, the more likely people are to trust you with credit. Here's how it typically breaks down. If your score is between 300 and 579, that's considered poor. At this level, you may have trouble getting approved for most credit cards or loans. If you do get approved, the interest rates will likely be very high. Some landlords may reject your rental application, and utility companies might ask for a deposit before turning on service. It doesn't mean you're a bad person. It just means lenders see a history that makes them nervous missed payments, collections, or very limited credit. If your score is between 580 and 669, that's considered fair. This range is often called subprime. You'll likely qualify for some credit cards or auto loans, but the rates won't be great. You may still be denied certain offers, but it's a step up from the lowest tier, and it means there's room to grow. Between 670 and 739, your credit is considered good. At this level, you're likely to get approved for most loans, including mortgages and car loans, with reasonable interest rates. You have some options, and lenders view you as a reliable borrower. It's not perfect, but it's solid. It gives you leverage, and it shows you're on the right track. Now, if your score is between 740 and 799, you're in the very good range. This puts you in a strong position. You'll likely qualify for excellent rates and premium credit cards. Landlords and lenders will view you as very low risk. At this stage, you've proven you can handle credit responsibly over time. You've built trust in the system, and you'll start to benefit from better deals across the board. Finally, if your score is 800 or above, that's considered excellent. This is the top tier. It doesn't mean you're rich. It doesn't mean you've never made a mistake. It just means you've consistently managed your credit well over a long period of time. With a score like this, you're likely to get the best rates available. Lenders may even pre-approve you for offers. You have options, leverage, and control. Now you might be wondering, how common is that? Not very. According to recent data, only about 20% of Americans have a score over 800. But many people are in the good or very good range, and that's often enough to access most financial opportunities. The difference between good and excellent might only mean a small change in your interest rate. But the difference between fair and good, or poor and fair, that can mean thousands of dollars over the life of a loan. Let's put it into perspective. Imagine two people applying for a $30,000 car loan. The person with excellent credit might get an interest rate of 3%. Over 5 years, they'll pay about $2,300 in interest. The person with fair credit might get a rate of 12%. Over 5 years, they'll pay over $10,000 in interest. Same car, same price. Very different costs just because of credit. So if you're in a lower range right now, don't panic. Your score can change. Every payment, every credit decision, every balance you pay down, it all adds up. And if your score is already in the good or very good range, protect it. Keep your habits strong. Don't open new accounts without purpose. Don't close old cards without checking the impact. And always pay on time. Remember, your credit score is not just a number. It's a summary of your financial behavior. And while you can't change your past, you can absolutely shape your future starting with the decisions you make today. In the next part of this video, we're going to talk about what can hurt your credit score, the mistakes to avoid, the habits that seem harmless but can cause real damage. Because understanding what not to do is just as important as knowing what to aim for. So stay with me. You're about to learn how to protect what you're building. Now that we've covered what credit scores mean, let's talk about the things that can damage your score and how to avoid them. Because no matter how strong your score is today, one wrong move can drag it down. And often, people don't even realize they're doing something harmful until it's too late. So let's go over the most common credit mistakes. These are the silent killers of good credit. First, the most obvious one: missing payments. We've said this before, but it's worth repeating. Your payment history is the biggest factor in your credit score. Just one missed payment can cause your score to drop significantly, and that impact can last for years. Late payments are usually reported if they're 30 days or more overdue, and the longer it stays unpaid, the more damage it causes. If there's one thing to protect at all costs, it's your on-time payments. To avoid this, consider setting up automatic payments for at least the minimum due. That way, even if life gets busy, you won't accidentally forget. The second mistake is using too much of your available credit. This is called high credit utilization. Even if you're paying your bills on time, carrying a high balance relative to your credit limit sends a signal that you might be financially stressed. For example, if your credit card limit is $5,000 and you're carrying a balance of $4,000, your utilization is 80%. That's considered very high. Try to keep your usage under 30%. If you can keep it under 10%, even better. And remember, this applies to each card individually and to your total credit use across all accounts. The third mistake is closing old credit cards without thinking it through. It might seem smart to close an account you don't use anymore, but closing a card can actually hurt your score, especially if it's one of your oldest accounts or if it has a high limit. Here's why. When you close a card, you reduce your total available credit. That can raise your overall utilization rate, even if your balances stay the same. And you also shorten your average credit history, which is another part of your score. So unless the card has an annual fee or is causing problems, it's often better to leave it open even if you only use it occasionally for small purchases. The fourth mistake is applying for too much credit in a short period of time. Every time you apply for a credit card or loan, the lender performs what's called a hard inquiry. A few of these over time is fine, but if you apply for multiple accounts back to back, it can signal desperation or financial trouble. Too many hard inquiries can lower your score, especially if you don't get approved for those accounts. If you're shopping around for something like a mortgage or a car loan, try to do it within a short time frame. That way, the credit bureaus will often group those inquiries together as one. But when it comes to credit cards or personal loans, space out your applications and always apply with intention. The fifth mistake is having no credit activity at all. Some people avoid credit entirely. No cards, no loans, nothing. That might feel safe. But in the world of credit scoring, no history is almost as bad as a bad history. Lenders can't evaluate your risk if there's no information to go on, and that means you may struggle to get approved or pay higher rates, even if you've always been responsible with your money. So if you're someone who prefers using cash or debit, consider having at least one credit account used lightly and paid off regularly to start building your history. The sixth mistake is ignoring your credit report. Your credit report is what your score is based on, and sometimes it contains errors, accounts you don't recognize, wrong balances, or missed payments that shouldn't be there. These errors can drag down your score for no reason. That's why it's so important to check your credit report at least once a year. You can do it for free at Annual Credit Report. Or if you find something wrong, you have the right to dispute it and have it corrected. The seventh mistake is falling victim to identity theft or fraud. If someone opens a credit account in your name, racks up debt, and never pays, it could wreck your credit and you might not even know until it's too late. That's why monitoring your credit is more important than ever. Many credit card companies and banks now offer free credit score tracking. Some even alert you when your score changes or when a new account is opened in your name. Consider signing up for credit monitoring or setting up alerts through your bank's API. It's a small habit that can protect you in a big way. So to recap, the 7 most common credit mistakes are missing payments, using too much of your available credit, closing old cards without a strategy, applying for too much credit too quickly, avoiding credit completely, ignoring your credit reports, and not protecting yourself from identity theft. If you can avoid these mistakes or fix them if they've already happened, you're already ahead of the game. Credit scores aren't about being perfect. They're about being consistent, being informed, and being just a little more proactive than reactive. In the next part of this video, we'll talk about how to improve your score if it's not where you want it to be right now. The good news is, you don't need to be rich or an expert to raise your credit score. You just need the right steps and a little bit of patience. Let's get into it. If your credit score isn't where you want it to be right now, don't worry. The good news is, credit scores can be improved, and in most cases, it doesn't take anything extreme, just small, consistent changes over time. Let's walk through the most effective and safe ways to raise your credit score, no matter where you're starting from. The first and most important step is to always pay your bills on time. We've said it before, but it's worth repeating again. Payment history is the biggest factor in your credit score. It accounts for 35% of your total score. If you struggle to remember due dates, try setting up automatic payments. Even paying just the minimum due on time helps you build a strong record. If you're late by a few days, call the lender right away. Sometimes, they won't report it if it hasn't passed the 30-day mark. Consistency is what matters most. One on-time payment after another builds trust and builds your score. The second way to improve your credit is to lower your credit utilization. Remember, utilization is how much of your credit you're using compared to how much you have available. If you can pay down your balances, start with your highest interest card or the one that's closest to being maxed out. Try to get your usage below 30% of the limit, ideally below 10% if you want the biggest score boost. If you don't have the cash to pay it down right now, another option is to ask your credit card issuer for a higher credit limit. This works best if you have a good history with them. Just be sure not to spend more just because you now have more room. The third strategy is to keep your old credit accounts open. Length of credit history affects about 15% of your score. The longer you've had an account, the better, especially if it has a good payment history. Even if you don't use a card often, keeping it open can help by improving both your utilization rate and your average account age. Use the card every few months for a small recurring charge like a streaming service or phone bill, and pay it off in full to keep it active. The fourth strategy is to avoid opening too many new accounts at once. Each time you apply for credit, it creates a hard inquiry on your report. Too many in a short period of time can temporarily lower your score. If you need to open a new card or take out a loan, that's okay. Just do it with a plan. Space out your applications. Only apply for what you truly need. The fifth tip is to diversify your credit mix, but only when it makes sense. Your credit score slightly favors people who have experience managing different types of credit, like installment loans, credit cards, and mortgages. If you've only ever used one credit card, and you're financially ready, adding a small installment loan or a second card could help in the long run. But never take on new debt just to improve your credit mix. Only do it if the loan or account serves a purpose in your financial plan. The sixth action you can take is to become an authorized user on someone else's credit card. This strategy can help you build credit quickly if it's done right. Here's how it works. Let's say your parent or spouse has a credit card they've used responsibly for years. If they add you as an authorized user, that account's history can show up on your credit report, and that can raise your score. Just make sure it's someone who always pays on time, has a low balance, and isn't carrying any negative marks. You don't even have to use the card. You're benefiting from their good behavior. The seventh way to boost your credit is to regularly monitor your credit report. You can check your reports for free once a year at Annual Credit Report. Some apps and banks even let you track your score every month. If you spot any errors like a payment marked late that was actually on time, or a loan that doesn't belong to you, you can dispute them with the credit bureau. Correcting mistakes can give your score a lift. Also, credit monitoring helps you catch fraud early. The sooner you act, the less damage it can do. Now, let's address one more thing. Improving your credit score takes time. There's no magic trick or instant fix. You might not see big changes overnight, but if you stick to the basics, the results will come. Your score might go up a few points after your next payment. It might jump after paying down a balance. It might rise slowly over months as your credit history grows longer and more consistent. And that's okay, because building credit is like building a reputation. It happens one choice at a time. So let's recap. To improve your credit score, always pay your bills on time, lower your credit card balances, keep old accounts open, don't apply for credit too often, maintain a healthy mix of credit types when appropriate, consider becoming an authorized user with someone you trust, and check your credit report for errors and signs of fraud. These steps are simple but powerful, and they work whether your score is 550 or 750. Whether you're rebuilding or just fine-tuning, in the next and final part of this video, I'll share a real story, a case study of someone who improved their credit score and changed their financial life. Because credit isn't just about numbers, it's about freedom, opportunity, and peace of mind. Let's wrap this up with a little inspiration. Let's end this video with something real. Meet Lisa. 2 years ago, Lisa had a credit score of 568. She was in her late 20s, had just started her first full-time job, and was living paycheck to paycheck. She had student loans, 2 maxed-out credit cards, and a few missed payments from when money was tight. She didn't think much about her credit score until she tried to lease a car and got denied. The dealership told her, "You need better credit." She felt embarrassed, frustrated, and honestly, a little hopeless. But that moment standing in the dealership parking lot became a turning point. Instead of ignoring the problem, Lisa decided to learn. She spent an afternoon reading about credit scores. She watched videos like this one. She made a plan. Her first step, she called her credit card company and asked if they could lower her interest rate. They said no, but now she knew her options. Next, she set up automatic payments just for the minimums. Then she got a side gig walking dogs on weekends. Every extra dollar went to her smallest balance. She didn't pay everything off overnight. It took months. But slowly, things started to shift. After 6 months, her credit score rose to 630. She qualified for a secured card with no annual fee. She used it to buy groceries, paid it off in full, and never touched more than 20% of the limit. She set reminders to check her score once a month. She reviewed her report and caught a medical bill that was wrongly listed as unpaid. She disputed it. It got removed. A year later, her score hit 700. Today, Lisa's score is 748. She drives a car she financed herself. She has one credit card she actually uses and two she keeps open for history. She pays everything on time, keeps her balances low, and knows exactly where she stands. And the most important thing, she feels in control. No more surprises. No more shame. Just clarity. Now, I'm not telling you this because Lisa is special. I'm telling you because she's just like many of us. She made mistakes. She faced financial stress. But she took ownership and step by step, she turned things around. You can too. Whether your score is 500 or 800, the goal isn't perfection. The goal is awareness, progress, control. Your credit score doesn't define your worth. It's just one piece of your financial picture, but it's a piece that, once you understand it, can open doors you didn't know you could walk through. So here's your action step. After this video, take 5 minutes to check your credit score. Many banks and apps let you do it for free, or go to Annual Credit Report. Come to get your full report. Look at your numbers. Not with fear, but with curiosity. Ask, what's one thing I can do this month to move forward? Maybe it's paying a bill on time. Maybe it's paying a little extra on your balance. Maybe it's disputing an error. Maybe it's simply learning more. Whatever it is, do it. Small steps lead to big change. And if this video helped you, consider sharing it. Maybe you know someone who's afraid to look at their score. Someone who thinks they'll never qualify for a loan. Someone who needs a little hope and a clear plan. You can be the reason they take their first step. And if you haven't already, subscribe to this channel. Because here at Money Mastery Now, we're not here to judge. We're here to guide, to simplify, to walk with you as you build a financial life you can be proud of. In our next video, we're going to talk about how to track your daily spending the easy way. You'll learn how to stay on top of your money without spreadsheets, stress, or guilt. Until then, remember this. You are not behind. You are not too late. You are not broken. You're learning, you're growing, and you're moving forward one decision at a time. Thanks for watching Money Mastery Now. See you in the next one.